All right, good Thursday afternoon, Finom Group members, and to our general YouTube audience, investors around the world, trading intraday. Welcome back to our weekly State of the Market. My name is Seth Golden. I am your host as usual. We typically like to start off our State of the Market looking at some pertinent quotes. Here's one: fear is the emotion that makes us blind. I believe this to be extremely true, especially when it comes to aspects of active portfolio management and just general trading investing. But I don't think anybody said it any better than Brian Feroldi. He says, in bull markets, investors are blind to the risks. In bear markets, investors are blind to the opportunities, thinking long term, right? We just get wrapped up in this state of fear, and it just blinds us to the opportunities long term. So just really pertinent given, the backdrop for the markets this year and just how skittish investors still are. Right, we're having this ongoing debate now. We've kind of shifted from, well, the market's just going to keep going down to, we've had a significant rally, but it was probably just a bear market rally, or it's the start of a new bull market. It's just this debate, and it really depends on what side of the investor camp you fall on. Are you a perma bear, or are you a savvy investor? I don't believe perma bears are savvy investors. Markets go higher over time. How can you possibly be a savvy investor if you're a perma bear? Don't at me on Twitter, as they say, right? All right, so moving on, we typically also like to start off our weekly state of the markets, kind of how did we get here, right? How did we start the week? And before we go into that, just kind of a look here at where the institutions, where the big money center banks are so far as their year-end price targets for the S&P 500. Right now, this is the latest. JP Morgan, 4,900, Oppenheimer, 4,800, BMO. So we got a number of institutions with price targets higher than where the S&P 500 is today. But that's only 1, 2, 3, 4, 5. We've got about 8 below where we are today with price targets mostly above 4,000, and a couple, the lowest one, Bank of America at 3,600. Just this week, though, Piper Sandler's chief equity strategist, because their price target's not on here, but Piper Sandler's Craig Johnson raised the S&P 500 price target to 47.75. So we found another bull. Market breadth, he says, was washed out in June, significantly reversed since and with a historically positive breadth thrust, which we've talked about in the past. We'll reiterate here today. We'll look at some of that. He says markets already discounted bad news, and he's not anticipating anything incremental really coming out of Jackson Hole. And that's probably the reality. Like, to the extent we make such a big deal out of Jackson Hole, right? Because it is a Fed event, it seems like the financial media and investors make it a bigger event than it actually is. It's really a place where they kind of just get together, have a few drinks, exchange thoughts, ideas. White papers are, thrown out to show how intellectual, their staff is at their Federal Reserve Bank, so on and so forth. But above and beyond that, we rarely get anything incremental to drive markets. So let's keep that in mind going into tomorrow's trading session. Friday, which will be Jackson Hole and Fed Chairman's speech at 10 o'clock a.m. after some key economic data comes out. All right, how do we get here? So we came into the week. Last week was options expiration week. It was another down week for the market, which is typical on August options expiration week. Here's 8th month. This comes to me from Quantifiable Edges, and I've been tracking it. The last time they really updated it was in 2018. but I've been monitoring and keeping, the data up to date. But it goes all the way back to 1984. By the month, the options expiration week for every single month. And what this basically shows, if we look at August, only a 54% probability of a positive week for the S&P 500. Again, that was as of 2018. 2019, I checked. Monthly options expiration week for August, down. 2020, I checked. Monthly options expiration week, down. 2021, I checked. Monthly options expiration week, down. This comes all the way down to like a 50-50 shot, literally. Literally. And lo and behold, 2022, August monthly options expiration week, down. Now, what also usually happens is that as we outline to our Finom group members in our weekly research report, is that we've noticed through our studies that options expiration days performance often bleeds into the beginning of the following week as options positions are settled. And it sure did. We had a terrible day Monday, Tuesday, got a little bit of a bounce yesterday on Wednesday here into today's trading session. We got some green on the screen, looking pretty decent. Folks, 4174. What am I talking about? Why am I pointing that out? Now, most of you who make it your weekly practice and part of your due diligence to tune into our state of the market, no. 4158, right? That's what we're looking for here this week based on previous studies, previous quantitative data. All right, don't want to get too long-winded there, but it looks like it's playing out. We'll see what happens tomorrow. All right, moving on. We also knew that Monday maybe not so great, not just because options expiration bleeding into the early part of the following week, but because Mondays suck in general. This data goes back to 1950. Monday is the worst, delivers the worst return on average since 1950. In fact, 13% of all S&P 500 declines since 1950 came on Monday. The best trading day of the week, Wednesday, or the best potential return of the week is Wednesday and Friday. It seems kind of inconsequential and off the cuff, but these patterns, I mean, they work. They work. I saw this tweet on Twitter the other day. I forget who said it because he retweeted this chart of mine. And his son asked him, "Dad, what is it like? What is investing like?" And his response to his son was like, "Well, gather up all your toys, throw them out the window on Monday. Throw them out the window. Then you spend the rest of the week picking them up and bringing them back inside." I thought that was pretty darn good. All right, again, how did we get here to where we are this current week? With the finding resistance at the 200-day moving average. That's what this chart is identifying. This is the S&P 500 one-year chart. There's that 200-day moving average, which we pretty much kissed last week before getting pushed back. So we found good resistance there. One thing I emphasized also in our weekly research report, and I highlighted here with the diamonds, looking at S&P 500 bear market rallies since 1950. Since 1950, you actually don't see many bear market rallies. In this case, rallies after the S&P 500 falls 20%, but then reaches the 200-day moving average, then fall back down to new lows. It doesn't happen. It's only happened. I shouldn't say it doesn't. It so rarely happens, in fact. Only 2 examples. And both times it was in 2002. So for all the people that say, "Oh, beware, this is just a bear market rally." But we found resistance, now we're going to make new lows. No, that's just not really the way it works. It's not. You have to believe, we're not the only people that know this. Right? We're not the only people that know that No, bear market rallies don't rally up to the 200-day moving average and then all of a sudden fall apart and find a new low. It doesn't work that way. It's fun to hyperbolize it that way, but history tells us, no, this is a real rally. This is something that could result in a new bull market. But there's that one thing that's got to certify it, and that is a close above the 200-day moving average historically. And by all historic data that we've talked about over the last several months, that is what we should expect to happen. A lot of the quantitative studies that we talked about push us higher. They don't scream of pullbacks that take us to test the former lows. All right, Katie Stockton from Fair Lead Strategy. She's a CMT, a certified market technician. She does very good work. She appeared on CNBC, I think this is Monday, August 22nd, basically promoting her belief that this is just a bear market rally, that we should fall back, test, and break the lows from June. We usually don't do this, but for this state of the market, I want you to hear for yourself her rationale as to why she believes this is just a bear market rally. Hopefully this works. Let's try it.
The action that we saw, which was a pretty solid July and beginning to August, did you ever question your thesis that it would be a kind of a false bear market rally that was doomed to take us to new lows eventually? Did you ever question that? And where do you stand right now?
I mean, listen, we're always questioning ourselves. I think that's just very natural. And yet the indicators didn't turn.
Oh, come on. No commercials. I'm in the middle of a live video here. All right, we'll get through it, folks.
So the indicators, because they're mathematical, they're price-based, they really don't lie, and we have to stay on the right side of them. Short term, we saw momentum, of course, behind that relief rally. We saw the NASDAQ 100 up 24% off the low, much higher than we would have expected. And now, of course, the 200-day moving averages are in play as potential resistance. So short-term momentum, just really as of Friday, started to fall off, and that's for the first time based on our gauges since late June. So it does mark a meaningful shift, and yet the relief rally, as big as it was, it never affected the longer term gauges in a positive way. So that,
all right, her rationale, her first rationale or reasoning why she thinks just a bear market rally is the long-term momentum or moving averages were not structurally changed in a meaningful way. Sounds legit. I think that's decent rationale to consider. So let's lock that one up for a moment. Keep that in mind, the long-term moving average.
To us, meant that we needed to stick to our longer-term bearish bias and just kind of hold off on recommending hedges until now that we have that loss of short-term momentum.
What's the most important index right now? You mentioned the NASDAQ. You've talked about the S&P a lot. The 24% move from the lows in the NASDAQ did surprise you, but and we did see some 50-day moving averages, some individual stocks. We saw a widening of the breadth and the participation. So all those things, at one point, it sounds like they had you saying, "Whoa, maybe this is a show me market that's showing me that it's headed higher." Correct? Or yeah. But go ahead.
The reason we're skeptical about that is because we think this is a bear market cycle, not a correction. Corrections.
All right. Bear market cycle. Rationale number 2. Bear market cycle, not a correction.
And in that kind of V-bottom fashion, but bear markets really cannot.
Bear markets cannot V-bottom. Apparently, she did not show up for school back in 2020, right? That was a bear market. That was a V-shaped recovery.
We've always suspected that some kind of basing phase or bottoming process is needed, and that takes time. It would be unlike what we saw just at the June low. Indeed, there was that breadth for us that was very widely publicized. when something's as widely publicized as that, I kind of feel like it makes me doubt it.
What? Huh? Say who? Because it's publicized, because people know about it? That's reason to doubt it? Not the actual context of the data, but just because people know about it. All right.
But we saw a lot of stocks get above their 50-day moving averages. That was certainly a breath surge, and yet it's so quick to contract, and we just don't want to get ahead of ourselves and sense that that's something that has any sustainability. In fact, our breath measures got quite overbought. Things like that percentage above their 50 days, but also the McClellan oscillator. There's a lot of measures out there that, to me,
that's what breath thrusts do. They get you overbought.
You got to unsustainably high levels. And now we're leaving that condition.
You don't see a 50% retracement of the move from the lows and then another resumption of an uptrend. You think that the 3,600, let's move back to the S&P since.
Aha, the 50% retracement rule. Aha, insert Eddie Murphy laugh.
I just have those numbers handy. The 3,600, what was that, a June 16th low or so? You think that that's going to be violated at this point? We just won't see some backing and filling. And if we did, I imagine you'd get some of the spikes in the VIX and some other sentiment indicators that might make for you a more lasting bottom. You think we're going back to 3,600 or below on the S&P?
I do. I think there's definitely risk of that, certainly with the downtrend still appearing to have its hold. We didn't see any major resistance levels broken on the upside, so that was one issue. But again, that long-term momentum remains to the downside. We're looking at risk assets like Bitcoin as well as really upholding its long-term downtrend. So no signs of life there, in our opinion, long-term as of yet, despite the fact that we have our initial long-term oversold reading. It tends to see a series of retests. We saw that in 2008. And unfortunately, looking at the VIX or volatility index, you can go back and make a comparison to about May 2008.
Don't do it, Katie.
Traded up until just last week. So I don't take any solace in that we haven't seen a VIX spike. I think, unfortunately, that the market probably needs that.
No significant VIX spike, right? The dreaded 40 plus on the VIX that we've been hearing about all year long, right? The VIX has to get above 40 to capitulate for the market to capitulate.
At some stage, the 35 level is resistance for the VIX, and even between here and there, that could be pretty painful. And for the major indices, there's about 6 to 7% downside just to the 50-day moving averages. And you can imagine what that would do to market sentiment.
And I'm done with this girl. All right. So she gave you a rationale. Is she wrong? Is she right? Is she in between? We don't know. Like, we can't predict the future. What I can say is she gave us her rationale as to why she thinks we're going to find new lows, break those lows. And, we all heard the dismissive nature of the breath thrust and the proclaiming of long-term moving averages not being structurally changed, the long-term momentum not being structurally changed. Now, we've looked at this before, right? This is today, right? And that's the 200-day moving average there. We kissed, we got pushed back. Here it was in 2007, 2008. Kissed it, got pushed back. Here it is twice in 2000 to 2002, right? We talked about that 2002. It happened twice. Kissed and pulled back, right? So that's what everybody's worried about, or what she's referencing. But here's something else. If we go back and we look at the chart, right? We talked about 2007 to 2008. Well, when you look at the slope of the 200-day moving average here in 2009, because remember, the market got above its 200-day moving average and never dropped below it. Now, what most people are talking about, technicians are talking about so far is, the long-term structure of the market hasn't changed. They're talking about the long-term moving average. That's the 200-day moving average. It's not the 50-day, 100-day, 20-day, 5-day. It's the 200-day moving average. And indeed, back here in 2009, we had this super duper rally back above the 200-day moving average. Did the structure the slope of the 200-day moving average change? No, it's still going down. This market has rallied significantly, getting a little bit of consolidation. Here we're already above, in June, we're already above the 200-day moving average. It has not structurally changed, and it didn't structurally change until August. You see it curling higher. Not until August. In other words, this is not a signal. Just because the long-term structure of the market, as predicated by the 200-day moving average, hasn't structurally changed, it didn't stop this bull market. So I don't agree with characterizing this as just another bear market rally and insisting that new lows are going to be found because of the structure. I don't see that as being valid. And that was just one case in point. She mentioned or dismissed the fact that, 90% of stocks got above their 50-day moving average, their shorter momentum moving average. But that didn't happen in 2000 to 2003. It didn't happen. It didn't happen in 2007 into 2019. It did happen this time. That's different than those bear markets. Very different. We know what happens historically. You can go all the way back to 1940, folks. 1940. We'll stop here because ever since then, when you've had, after a 20% correction or greater, after a 20% correction or greater, if you've gotten 90% or greater stocks above their 50-day moving average, 1 year later, all positive returns. All positive returns. And 21.3% is the median return. You're dismissing that? That's a breath thrust that you're publicly dismissing, I think. Now, it doesn't mean we won't get pullbacks. It won't mean that, like you said, we got overbought. This is a breath thrust. We got overbought. So we're consolidating. And indeed, what we've learned, and this goes back to 1988, it's the same study. S&P 500, after 90% of stocks in the S&P are above their 50-day moving average. Drawdowns since 1988. Yep, let's make sure. There it is, 1988. That's the signal. So that's where we started. Drawdowns, 7%, 0.1%, almost 8% here, 1%, 1%. No real drawdown in 2020. 252 days later, all positive returns. All positive returns. So you can back and fill, you can consolidate. It doesn't mean we're going to go retest the lows. Now, here's the other thing to consider, right? This is for the yeah, but crowd. The folks that, yeah, but the Fed's tightening. The Fed is going to run down their balance sheet while they're raising rates. The yeah, but crowd. So I'm going to read this here. At the recent high, about 93% of stocks within the S&P 500 were trading above their 50-day moving average, fitting the definition of a breath thrust. What makes it unique relative to others in history, other breath thrusts in history, however, is that the Federal Reserve is in an aggressive interest rate hiking campaign. Other than in February 2019, when the Fed was on hold, the 9 other breath surges off the lows, and this goes back to 1975, all occurred during Fed easing campaigns. The data was checked by Strategas. In addition, all 10 prior breath surges, which would now include 2019, were accompanied by a positive 2 by 10-year yield spread, meaning the yield curve wasn't inverted. As most readers know, that yield spread is decidedly negative today. I think we came in today with like 30 basis points of a yield curve inversion. So the past 10 breath thrusts, all either the Fed was on pause or the Fed was easing, and none of the occurrences had the yield curve inverted. Yeah, but, right? And this is where you got to kind of really think about it. I'm espousing this to you. I'm sharing this information with you. This comes from Strategas, and it's been promoted by Charles Schwab, TD Ameritrade, the biggest of online brokers in North America. Who doesn't know this, right? Who doesn't know that going back to 1975, when this breath thrust occurs, it has never occurred in a Fed rate hiking cycle or with the yield curve inverted. And yet, it just happened. Millions of investors, thousands and thousands upon thousands of portfolio managers know the Fed is going to keep hiking. They know the economy, certain pockets of the economy are troubled. And yet they just bid the market to the degree that it triggered this breath thrust. You have to be of the opinion that these millions upon millions of investors, thousands upon thousands of portfolio managers are ignorant. To do this anyway, that's the real question here. Is that what you believe? They're just ignorant. Otherwise, they would have never, knowing all this, they would have never done that. They're all ignorant. I think that when this kind of information is shared and when people do the yeah, but thing, I think we come at it from the wrong angle, which is to kind of defend by deflecting, right? We do, yeah, but the consumer, yeah, but the savings rate, yeah, but look at retail sales, yeah, but no. It's very simple. Your yeah, buts regarding Fed hiking in the yield curve, your yeah, buts have to equal a belief that millions of investors and hundreds of thousands of portfolio managers are just ignorant. That's the way I can put it to you, folks. All right. And here is that 50% retracement that we saw the host ask her about and how she deflected that as well. And as a reminder, we've never retested the low since 1972 when we've had a 50% retracement. It has to happen on a closing basis. It did happen on a closing basis. Here's the other thing. You have to believe they were buying everything. It's not just that they were buying, they were obviously buying everything. When we look at a chart of the equal weight, this rally here, when we look at its equal weight, it's the value geometric line, and it's the S&P 500. They're running in tandem through that rally from the bottom in June into early August. They're all ignorant, right? Anyways, the advanced decline line made a new all-time high for the S&P 500. We talked about that in the past. But here's some good data as well to coincide with that. It's typical. This comes from Ryan Dietrich. Within the first 46 days of this bull market, the S&P 500 pulled back 4.10%. Okay, within the first 46 days of this bull market, we've just had a pullback. Again, if we're suggesting the bear market ended in mid-June, we're 46 days beyond that, and we've just pulled back 4.10%. 46 days into the great bull markets in 1962, 1970, 74, 87, 1998, 2002, and 2011, the S&P 500 began or completed pullbacks of 10%, 9%, 13%, 7%, 10%, 14%, and almost 10%. In other words, pullbacks are supposed to happen. We just rallied 16+% in the S&P 500, 24% in the NASDAQ. It's healthy to consolidate. Bull markets in the past have consolidated. This is not time to run for the hills and be afraid that it was a bear market rally. This is time to look for opportunities to buy this consolidation. As I've said before, at this point, really the only thing that could or should deter the historic data from continuing this march higher in equities over time and finding new lows is a macro event. It has to come from the macro fundamentals. The technicals are too strong. This is from Carson Wealth Management with Ryan Dietrich. S&P 500 advanced decline line made a new all-time high last week. It's rare to see this happen, though, with the S&P 500 more than 10% below its all-time high. But history says new highs could be coming because usually breadth leads price. What we see in the chart here is that when the S&P 500, this goes back to 2010, when the S&P 500 has made a new, the S&P 500 advanced decline line has made a new all-time high. 7 out of the last 7 times going back to 2010, 1, 2, 3, 4, 5, 6, 7, 8. This includes the most recent, but the previous 7 times, the market was up a year later, all 7 times. It's a good signal. And again, if you think that the market's going to go and retest the 3600s and break that, you're ignoring this data, just like all the other data. You have to. We've talked about valuation. We've talked about the equity risk premium periodically here on the weekly state of the market and in our weekly research reports, which if you don't receive Sunday mornings, go subscribe at phenomgroup.com. It's only $9.99 a month. You get our weekly state of the markets on Thursday and our weekly research report Sunday mornings. So our equity risk premium, we keep doing the calculation because we want to know where's the greatest yield we can find for our capital investment dollar. Going back to 1977, we've been above the average. This dotted line here is the average at 2.7%. We've been above the dotted line, pretty much ever since the pandemic. So it has been a good idea to go into equities as opposed to bonds. It's generally a good idea to always be in equities as opposed to bonds. But when we ask ourselves, was it overbought conditions, that caused this pullback? I mean, you could say yes, because it would be valid. I mean, the 14-day RSI on the S&P 500 and NASDAQ got above 70. That's overheated conditions. So you can say yes, but you can also say that the equity risk premium showed that it was probably a better value in the risk-free 10-year treasury as opposed to equities most recently. How do we determine this? We take the earnings. How do you determine the equity risk premium? You take the earnings, which came down from 230 down to 225 this quarter through the earnings season. It's a little over 225, but we'll use whole numbers here. So it's down to 225. So we take the earnings and we divide it by the price of the S&P 500. At the time I did this exercise, it was 41.30 for the S&P. We take the earnings 225 divided by 41.30, our equity risk premium, well, our calculation comes to roughly 5.4%. Now, to complete the equation, we have to subtract the 10-year yield, or the risk-free rate, which at the time was 3%, right? We crossed above 3% on the 10-year yield this week. So we take our 5.4%, we subtract 3%, and that gives us 2.4%. Remember, the average going back to 1977 is 2.7%. We're below the average. Not only is the equity risk premium below the average equity risk premium since 1977, it's below the 10-year yield. And markets consolidate. Where's the greatest value for my capital dollar? Now, does the fact that it's below the 10-year yield mean that investors won't buy stocks? This is the cause for investors not buying stocks? No. We spent a lot of time in the past below the average, and of course, in the past, below the 10-year yield. What this is really telling you is, look, if you're going to go buy stocks, you're assuming greater risk than in the risk-free rate. So how much of that risk do you want to carry in your portfolio so far as equities are concerned? All right, and indeed, every time this year, every time, it's happened 6 times this year, when the 10-year yield, ticker symbol TNX, crosses above 3%, the S&P 500 has fallen all 6 times over about a 5-day period. But then it's rallied. It's rallied after that. And we typically have not made up for the losses until day 19. But it's happened every single time the 10-year crosses back above 3%, the S&P 500 has consolidated or found deeper, lower lows, if you will. All right, the dollar is on everybody's mind, right? We're at dollar parity again. It's weighing on markets. It's compressing equity multiples all year long as the dollar is up mightily. But what we've seen in the past, this happened here, right? We had this parabolic move in the dollar, right, during COVID. But what we also notice is this spike right here to probably multi-year highs in the dollar. And then it spiked again, but the second time it spiked, the RSI did not get as high as the previous time. So we recognize that as a bearish momentum or relative strength divergence. New highs here, but lower highs in the RSI. Well, fast forward to today, we had another similar spike up here. This is a more protracted uptrend, granted, but this last move was pretty parabolic, consolidated some of those gains, and made a higher high this week. But same situation. Note, this higher high is not associated with a higher high in the RSI. We have another bearish relative strength divergence. I would be of the opinion in the not too distant future, we're going to see dollar weakness. This would look like a great double top here. This might be the same kind of double top that is forming today. And if that proves to be the case, when we get these kind of moves and this kind of sentiment for the dollar, like everybody loves the dollar all of a sudden, historically, returns on the dollar are poor across most all time frames. The positivity rate on the dollar's performance, every single time, it's below 50%, going all the way out a full year. I don't believe long dollar is a good bet here long term at these levels, and the data basically supports that. We're in a recession, right? No. To the extent that they keep beating that drum, we continue to look at the Philadelphia Coincidence State Index, which updates every month, usually the 3rd or 4th week of a month. And this just came out this week. And what it basically tells you is the GDP, the state of GDP, gross domestic product, or economic activity in each individual state, color-coded. And we have one state, Montana, which is deeply in contraction. Keep in mind, you got 2 people living in Montana. Maybe both of them decided not to show up for, I don't know, I'm being facetious. And Alaska, the 2 most populous, the least populated states in the union, and they're in recession. We have one state that is unchanged, Indiana. That got worse. But we have a lot of states that actually got better. The point here is the United States of America can't be in a recession with only 2 states in a recession. So every month this updates. It's a really useful tool to kind of denounce, if you will, this drumbeat of we're in a recession, we're in a recession, we're in a recession. Sven Heinrich tweeted this out. I thought this was really funny. I think most of Sven Heinrich's tweets and commentary are funny, if not nonsensical. He says, so if you think a Fed pause after the next rate hike in September will avoid a recession, it's not. It will guarantee one. And if so, then earnings estimates for 2023 are way too high, especially if financial conditions go into restrictive territory. He shows this chart, right? And it looks like, this is the Fed fund rate, Fed fund effective rate in the dark color. And this is the federal debt, right? That always goes up, so who cares? And he does his, whole trend line nonsense here. And the Fed is attempting to get to around 3.5% to 4% during this rate hike cycle to combat inflation. But don't lose sight of his point. If you think a Fed pause after the next rate hike in September will avoid a recession, it's not. It will guarantee one. Why is he saying that? Again, the recession are shaded in gray. These bars here are when recessions start. And so here they paused. We had a recession later, right? They paused, I think, 88. We had a recession in 90. Here they stopped raising rates. We had a recession the next year in 2001. Here they stopped raising rates in 2008 or 2007, and we had a recession in 2008. Right. So, but it's distracting. Here's the thing that he's not going to show you. You probably already picked up with this, by the graph, but I've blown it up to show you the reality with arrows. Stopped raising, market's doing fine. Economy's doing fine. Stopped raising, economy, no recession, no gray shaded bars. Again, no gray shaded bars. Oh, looky here, no gray shaded bars. Looky here. No gray shaded bars, right? And think about 2019, right? The Fed stopped in 2018, December 2018, the Fed stopped hiking rates. 2019, did we have a recession? No, we had a 31% S&P 500 return. You're right, the Fed rate hikes did pause. The Fed pausing rate hikes throughout all 2019 caused the pandemic recession of 2020. Well done, Sven Heinrich. So, come on. But this is what he does. He can distract you, right? Most people are just going to take it for granted and say, well, he's got his trend line there and he's commenting. Oh, he's got a check mark on Twitter, so must be right. No, try again. This is how I think about these guys on Twitter and just the financial media in general. If you haven't picked up on that in our SOTMs previously, CNBC equals what a few people are saying. The price, what the market is doing, that's what you got to pay attention to. Every single guest on CNBC, every single one, right? Because for the last several weeks, all we have heard, the market thinks the Fed has pivoted. But every single guest that comes on CNBC or Bloomberg, I don't believe the Fed has pivoted. The host of these shows and programs and financial media, they're espousing, they're saying the market has rallied because they think the Fed has pivoted based on the last FOMC meeting. But every guest says, no, I don't believe they have. If nobody believes it, then why is this the promoted cause of the rally? It's a rhetorical question. It's an example of the nonsense, right? They just paint a narrative, make an excuse for this, that, and the other, why the market's doing this, that, and the other. It's far from reality. And the guests are literally invalidating the narrative. This chart right here, also from Carson Wealth. The Fed keeps hiking until the Fed fund rate is greater than the CPI based on previous cycles. Fed fund rate every time. It's the lighter shaded line here. So yeah, every time they hike until it's greater than CPI. Every time. Right now, CPI is greater than where the Fed rates are. Right, so that seems worrisome. It might seem like we have a long way to go. But remember, we don't know how fast or how far this is going to come down CPI. So we don't know, and the Fed doesn't know how fast or how high they'll have to go to fight inflation. Here's the other thing, because right now, most people are of the opinion the Fed is going to hike until 3.5% to 4%. Until the Fed fund rate is at 3.5% to 4%. Right now, it's around 2.5%. I don't believe that. I don't think that's going to be the case. I could be wrong, but we don't know how quickly we're going to see inflation come down. Secondly, depending on the shape of the economy in 2023, or at the end of this year, towards the end of the year, the Fed's calculus may need to change. Everybody's thinking and of the opinion, that 4% is a high Fed fund rate. It's high since the turn of the century, absolutely. The Fed's targeted rate for inflation is 2%. So yeah, a Fed fund rate of 4% is extremely high. But keep in mind, these are just targets, and these targets can change. They're not in concrete. It's not cemented. And remember, CPI averaged 5.1% through the 1980s. From 1982 to 1990, we had an 8-year expansion cycle with inflation at 5.1%. There may come a point next year when the Fed realizes or options a different target rate for inflation. Instead of 2%, maybe it is 3%. Maybe it's 4%. It's not set in stone, folks. But that's what everybody, well, the Fed's model is, and so that's what they base their models on. Or I should say the Fed's target is, so we're going to model like this. The Fed is always, no, the Fed's never wrong. They're the ones driving the car. They decide where they want to go. If you've modeled if you made a model that they're going to go this way, but then they turn this way, sorry, you're wrong. The Fed's driving the car. Think about it like that, I guess. When it comes to inflation, we're going to get more data, the PCE, personal income, consumer spending, tomorrow, Friday. But we're not going to get the next CPI print until mid-month, I think September, for the month of August. One of the things we really would like to see is rents come down. Owner's equivalent rent is been pretty sticky, and it's kind of been the thorn, in this inflation cycle. We've seen commodity prices roll over, hard commodities, soft commodities, energy prices. We've even seen, used vehicles. They've rolled over. They just got reported the other day. Manheim used vehicle value index fell to its lowest level of the year. Like, that's all good stuff. But this is the one that we really need some help with. And rental price index will be out, I think, tomorrow, actually, as well. All right, folks, I give you a lot to chew on. Hopefully, you can digest all the information and make some really sound decisions. I was calling for 4,300 back in June. I thought that we could, at some point, find a trough and rally up to 4,300. That has taken place. At this point, I think the market can tune into this weekend's weekly research report. Until then, have a great trading week, everybody.